Hey guys, welcome back to the channel. In this video, we're going to talk about CEI and the reverse stock split. We're going to really kind of dive into what the reasoning is behind a company doing a reverse stock split, and then we'll take a look at the charts and I'll kind of give you my thoughts moving forward. So we'll take a look here. This is off of Investopedia.com. It says, why would a company perform a reverse stock split? A reverse stock split is a measure taken by companies to reduce their number of outstanding shares in the market. Existing shares are consolidated into fewer, proportionally more valuable shares, resulting in a boost in the company's stock price. So basically, if you're familiar with a regular stock split, how basically they produce more shares and they lower the price, this is the complete opposite. Is basically they're taking away the shares and increasing the price, but leaves you basically with the same value, and we'll kind of do the math on that. Key takeaway here says a company performs a reverse stock split to boost a stock price by decreasing the number of shares outstanding. A reverse stock split has no inherent effect on the company's value, with market capitalization remaining the same after it's executed. The path is usually pursued to prevent a stock from being delisted or to improve a company's image visibility. So this is how a reverse stock split works. During the reverse stock split, a company cancels its current outstanding stock and distributes new shares to shareholders in proportion to the number of shares they owned before the reverse split. For example, in a 1-for-10 reverse split, shareholders receive 1 share of the company's new stock for every 10 shares they own. In other words, a shareholder who owns 1,000 shares would end up with 100 shares after the reverse stock split was complete. Then goes on to say a reverse stock split has no inherent value in the company's value. It's with its total market capitalization staying the same after it's executed. Yes, the company has fewer outstanding shares, but the company's share price increases in direct proportion to the reverse split. The total value of the shares an investor holds also remains unchanged. If the investor owns 1,000 shares, each worth $1, before a 1-for-10 reverse split, the investor would end up holding 100 shares worth $10, which therefore still gives that same value. For companies that pay cash dividends, future dividends would simply be adjusted to reflect the new lower number of shares. So if a company paid its shareholders $1 per share dividend and it undergoes a 1-for-5, then the dividend becomes $5, or 5 times the old payout. Note that the overall sum of dividend payment should remain the same. So now into the reasoning behind reverse stock splits. To prevent being delisted from an exchange, if the price falls below $1, it's at risk of being delisted from the stock exchanges that have a minimum share price rules. Being listed on major exchanges is important for being attracted equity investors, and in some cases, the only way to prevent removal is to increase the share price by engaging in a reverse stock split. Boost the company's image if the stock prices drop dramatically. If the stock is trading in the single digits, it's likely to be viewed as a risky investment, particularly if the price is near $1 or considered a penny stock by investors. There's a negative stigma attached to penny stocks traded only over the counter or OTC markets, and sometimes the quickest method to escape the associations to protect the company's brand image is to engineer a reverse stock split. Draw more attention from analysts and influence investors. High-priced stocks attract more attention from the market to analysts, and a favorable view from analysts is excellent marketing for the company. They are also more likely to pop up on the radar of big institutional investors and mutual funds, many of which have policies against taking positions in stocks whose price is under the below minimum value. Just hang with me because we'll talk about CEI more in a second. We just want to get through this article. The criticism of a reverse stock split. Reverse stock splits aren't without flaws. In many cases, companies keen to artificially boost their price in this manner risk being spurned by investors. Reverse stock splits can carry a negative connotation. As previously stated, a company is more likely to undergo a reverse split if its share price has fallen so low that it's in danger of being delisted. Consequently, investors might believe that the company is struggling and view the reverse split as nothing more than an accounting gimmick. Okay, so a lot of buzz on Twitter about CEI for a lot of different reasons. The first one that I'll talk about is how if you follow on Twitter, if you've kind of kept up with some of the guys that got in trouble with the law as far as their alleged pump and dump scheme. CEI was one of the stocks that they talked about, and it's actually how I found out about them too. But I, obviously do my own thing. I found out that they were investing in it, so I got in. So I made a little bit of money and got out. But after that came out specifically, it was already kind of coming down, but I think that crashed it even harder whenever all that news came out. And now that the reverse stock split is in, obviously the share price is up, but your value is not changing. Okay, that's what people don't understand. I think a lot of the times is, it's back to $5 a share, but now in my opinion, you have more room for downside after that reverse stock split, and they could have just kind of covered their basis on, let's buy some time for us to not get delisted. Let's buy some time for us to kind of get the word out that our stock price is up, and hopefully, I guess people don't realize what exactly we did. So they did a 1 for 50, a 1 for 50 stock split. Reverse stock split. So if we look back at this example here for the 1 for 10, if you have, for example, in a 1 for 10, shareholders receive 1 share of the company's new stock for every 10 shares. So basically, if a shareholder held 1,000 shares, now they end up with 100. Okay, if I own 50 shares of a company, okay, and they do a 1 for 50, then now I'm down to 1 share of that company. Okay, and then what happens in return is the value shoots up by a certain amount, and then I basically multiply the value of the stock by the amount of shares I have, and it's going to equal out to the same exact thing that I had. Okay, so it's not going to increase my value at all. It's only going to basically deduct the amount of shares that I currently own at a higher value. But the problem with that is, if the stock has nothing going for it, okay, and it's not increasing on its own, and it only increased on the reverse stock split, and especially in market conditions like they are now, if the stock continues to come down, then I'm going to continue to lose money, right? Because if it shot up to, let's say $5 a share, right, and then it continues to come down to $3, to $2, to $1, I'm still losing money off of that investment, regardless of what that value was after the reverse split. Now I just own less of the company, if that makes sense. So let's take a look at the charts on CEI, and let's see what they're telling us. All right, guys, taking a look at CEI. This is Camber Energy. As you see, after the reverse stock split of 1 to 50, it shot up all the way to $5.27, but now we're steadily coming down. We're down all the way to $3.82. Your level of support here is going to be $3.28, and if you break below that, which I know people are all excited and going crazy over CEI, but I'm going to tell you now, we are coming below that. Is your next level of support is going to be 266 and 205, 117, and all the way down to 6 cents. So, and the reason I say that is, you see how overextended we are just based off of that reverse stock split. Again, I don't think really anything has changed with the company, as opposed to them just doing this and bumping the price up. So if you're looking to invest in the company, I would definitely kind of wait it out and do some more research on as far as what the company has going for them moving forward, not just the reverse stock split. I would be more inclined to invest if they did a 50-to-1 stock split as opposed to a 1 for 50 reverse stock split, because basically the stock, that's basically like a Tesla. Like, your stock price is so high that they're going to bring it down because they want to raise more money from and give the chance to institutional investors to come in and buy shares of that company. That's a lot more attractive to me, as opposed to, it's almost kind of misleading of bumping the price up and saying, oh, look at me, we're back to $5 again, when realistically you're not. We took a bunch of shares away, which made the value of the share price go up, but the overall value of the company is not changing at all. So anyway, guys, just wanted to provide you that update on CEI. Let me know your comments below. Let me know if you own it, plan on buying it, or if you've bought it in the past, and your thoughts on the reverse stock split. Other than that, we'll catch you in the next one.